Well, it was a bit of a shaky start to the second half of the year for equities. The S&P 500 notching its second weekly decline in three, slower than expected payroll growth, and a really chunky sell-off at the long end of the Treasury curve looked to be the reasons behind that decline. The dollar rolling over a little bit as well, just can't catch a bid despite a lot of solid economic data last week. An interesting development there that may put the bulls on edge. It's a busy week ahead. The latest US inflation data, the CPI print, certainly highlighting the calendar, but plenty else for traders to get their teeth into as well. The latest jobs figures out of the UK, central bank decisions from Canada and New Zealand, and also the start of Q2 earnings season with the banks beginning to report on Friday. Another busy episode of the Trade Off UK this week. So without further ado, let's get into the show. So plenty for us to discuss, as always, on the trade-off this week. Without further ado, let's bring in my co-host, Ryan Littlestone from Forex Blow Live and Forex Analytics. Ryan, good afternoon to you, mate. How are you doing?
Yeah, afternoon, mate. I'm all good. How are you?
Yeah, very well, thank you, mate. Very well. It sounds like from our little chat earlier on, recording the trade-off is going to be by far and away the most relaxing thing that either of us have done over the last couple of days, given the rather hectic weekends we've both had, mate.
Yeah, a bit of headbanging for me over the weekend, and I'm feeling all the worse for it at the moment. But yeah, that's what weekends are for, right?
Well, exactly. I mean, your hair must have been flying around all over the place when you were doing that.
Yeah, it does get in my eyes sometimes. I've got my hair band, so I'm all ready to ponytail up.
Well, right, headbanging out of the way. Ryan's done his little part supporting the UK hospitality and events industry over the weekend. Let's get into topical thunder and have a look at what's going on in the markets. Right, I want to start with the jobs number on Friday. It is the data release that everyone kind of loves to hate. Headline non-farm payrolls rising 209,000 in the month of June. It is technically the first miss compared to consensus in 15 months. We obviously had this really long run of the print beating expectations. But I was making this point to someone earlier on that the range of forecasts for the payrolls number was, I think, 110 to 350. So for it to come in 20K shy of the median expectation, I don't think we can really call that a miss if we're in a charitable mood. So I think it's probably close enough to the mark that we don't need to worry too much. If you dig into some of the other areas of the report, it's all very, very strong. Unemployment coming down a little bit to 3.6%. Earnings growth quickening slightly, 0.4% month on month, 4.4% year on year. So possibility of real wage growth continuing in the United States. And also participation is quite pleasing as well. The overall participation rate remained at a cycle high 62.6%. And when you look at prime age participation, which is 24 to 55, that hit a new cycle high at 83.5%. So clearly more people coming into the labour force. In that light, unemployment going down is an even more pleasing sign. And the pace of jobs creation, above 200,000, I think that's healthy enough. And there's more than enough in that report, in my mind, for the Fed to hike again towards the end of July. The market giving a 90% chance now to a 25 basis point hike from the FOMC on the last Wednesday of the month. But I think looking further ahead than that, for me, the payrolls number really isn't any sort of a game changer. We've got another 2 jobs reports, and we've also got another 2 inflation prints between the July and September Fed meetings. We're dealing with a Fed that's firmly in a data-dependent policy-making mode. And as a result of that, they'll have plenty of data to digest between the 2 meetings. So I want to get your thoughts on the market reaction to the jobs number as well as the data itself, because the big rollover that we saw in the dollar, the move low that we saw in yields, the rally in treasuries, and the softening that we saw in risk, to me just feels a little bit overdone, a little bit knee-jerk on a data point that probably won't change too much in the grand scheme of things.
Yeah, well, this is something that's developed all through last week. We had that big services number, the ISM, that came out very positive, and the same sort of reaction. We saw yields rallying. The dollar rallied initially, then headed south. And yeah, something's changed in the market, definitely changed in the market, because, the dollar is much lower than when we went in. And this is on the back of good data and with the US yields rallying as well. So there's something astray in the market at the moment in terms of the usual correlations breaking down. It is a global thing because yields across the board are rising as well. So there's a couple of trains of thoughts which we won't get into real depth. Who's the biggest sellers at the moment in the Treasury market? It's central banks offloading their balance sheet. So that's one reason why yields are continuing to rally here. But on the data front, strong numbers. But what we're starting to look at over our side of the desk, shall we say, is the quality of jobs. There was one thing that stood out in that ADP report last week. Huge number, 597. The jobs once again going into leisure and hospitality, some 232,000, I think it was. You could start saying that perhaps we're seeing the low-paid jobs picking up, and that's been doing a lot of driving. That tends to insinuate, as one of my colleagues, Delius, pointed out, maybe that's people taking on second and third jobs, as waiters, waitresses in bars and whatnot. You look at the ADP and some of the other numbers, and maybe the higher end of the pay scale, financial services, business, investing services, that sort of thing, all declined. So there is, I think, something developing where jobs data that looks good maybe isn't so good underneath. And I think that's what we need to be careful of in the months moving forward. Everyone's been waiting for the jobs market to tip. It hasn't. But I think there are signs underneath that are showing it may be getting closer to that point.
Yeah, I think that's a really, really good point that Stelios has made there. Actually, I'm slightly annoyed that I didn't come up with it myself now. While we're talking about him, I'll plug his book. Go and read it. It is very, very well worth a read. It is a very, very good book on a very important subject. Another important subject is obviously the jobs market. The other point on leisure and hospitality hiring, particularly at this time of year, it was the June labour market report. How much of that work is going to be seasonal? How much of that work is restaurants and bars going, we're in for a busy summer season. We'll take people on now in June and before the Independence Day and the summer really kicks off. And then after Labor Day, kind of late September, early October, we'll lay them off again. So you've got sort of two sides to that coin, not just people seeking extra income due to the cost of living and all the rest of it, but also companies looking for kind of temporary help to tide them over that busy period. And I wonder whether that's why we saw such a big divergence between the ADP number, as you said, which was 490, 500, and the payrolls print, which came in at 209. Is it because they're adjusting for seasonality in a different way? That may be a reason why, yet again, the ADP number proved that it was, as useless as a chocolate teapot in trying to predict where payrolls are going to go.
Yeah, possibly. I mean, you've got to remember there's a huge difference. Obviously, the ADP is all private, is a private report, so it's private employment, whereas the BLS is more of a national, a bit like our ONS, so it's a bit more in depth. But yeah, I'm not saying it's bad and we're going to see things collapse, but these are the little clues I like to look for. It was the same, again, going back to the ADP, in the sector industries, we saw manufacturing losing 42,000. We know manufacturing's been is in a slump at the moment across the globe. We saw construction picking up work. So what has Powell been telling us? The housing market is picking up. So no surprise to see jobs picking up there. So even though people brush off the ADP in terms of what it means for the NFP, fine, you can do that all day long. But the details are important. And the details are marrying up with what we're suspecting now about the jobs market. And as I say, we've been trying to predict when the job market's going to collapse for the last 18 months. We can keep predicting it. It's going to happen at some point. It naturally will. But for trading it, I just want to see those little clues picking up. And if they form a trend, that's when I start to think the end might be near.
Well, yeah, absolutely. I mean, it is those trends you need to watch. I just want to make one final point on jobs before we move on to the inflation data, because I'm sure we've both got plenty to say on that one as well. And that is that, we need to make sure that we're viewing the data not just in terms of a trend. We can't overreact to one report, as the Fed voter Goolsbee, I think it was, said on Friday. We're not going to overreact or even react at all to one data point. We also need to view it in the context of the Fed's forecasts, because because that is how it's going to impact on policy making going forwards. And the Fed, at their most recent forecast, which came out in June, they expected the unemployment rate to rise to 4.1% by the end of the year. Here we are, banging the halfway mark of the year, and unemployment's at 3.6%. So actually, the jobs market, I would argue, is still performing substantially better than the Fed expected it to be and expected to be doing by year end, even if we are seeing the pace of jobs creation cool. And I think that's an important lens via which we need to view the data. But we could sit here and talk about jobs all day, but I think we probably need to get onto the other side of the Fed's mandate, which is the inflation side of things, because that's going to be an interesting one this week, isn't it?
Yeah, the big CPI numbers, the first numbers for June out of the US. Is it going to leave us clear as mud again on the market reaction? Because depending on what we get, trading is a lot like a TV drama. You find something out, but it doesn't answer all the questions and leaves you on the edge of your seat waiting for more, or waiting for the next episode to happen to hopefully start making things clear. And it's a lot like trading. We want to see the NFP data, what it means for markets. We see the market reaction. Now we move on to the next episode, CPI. What's that going to mean for the dollar? And such is life with trading. So we've also learned that strong data, particularly last week, doesn't mean a strong dollar anymore. The US dollar got sold off on pretty much every good piece of data last week. However, yields rallied, as we said, all week. So something has definitely changed on that. So the inflation data, what are we expecting from this one? We're expecting a pretty steep pullback to 3.1% from 4% in headline inflation. The core is expected to soften only 3 pips to 5% from 5.3. Now, while Michael thinks there's already enough to justify a hike from the jobs data, would a CPI reading under 3% have the market or have the Fed hovering over the pause button instead?
Is that a question for me?
That's a question for you, mate. Pay attention.
That's a question for me. Sorry, I was half expecting you to carry on there. I didn't realise you were finished.
Definitely for you, mate.
Well, Kyriakos can answer it if he wants. The simple answer is no. I don't think it will. And there's a couple of reasons for that. Three reasons actually. Actually, maybe four. Sorry, I'm coming up with more reasons as I come to answer the question here. The first reason is core inflation. Is still going to be running a just above, if not just slightly below 5%. And I think that's what the Fed are really going to be looking at, because it is those underlying inflationary pressures, and this is my second point, particularly on the services side of the economy, that the Fed are really focused on. And Powell has said this in recent remarks and at the June press conference as well. A lot of the reason why headline inflation is coming lower so significantly is because of those factors like energy. It's also because of the pretty punchy year-on-year comparisons that it's got to beat from last year. You remember after the pandemic, we had the base effects that were pushing inflation higher. We've now got base effects that are pushing headline inflation lower, which I think the Fed will look through. And the other thing is, I think perhaps a cleaner way for us to start looking at inflation is to pay a lot of attention to the month-on-month prints that we get. And I know a lot of the time, and I'm as guilty of it as anyone, the month-on-month data, we don't tend to pay as much attention to it as we perhaps should. We all look at the year-on-year number. Is it coming down? Is it getting close to 2%? Yes or no? But if you look at the month-on-month data, we are expecting quite a big increase there. CPI expected at 0.3% month on month from pretty much flat prior. And then you start to actually annualize the month on month data or annualize 3 months worth of month on month data. And you then start to see that actually there hasn't really been much progress made in terms of bringing down that underlying inflation. So I think this is where you could end up with a bit of an interesting trading dynamic at the very least, because if you do get say a 2.9 on the headline CPI number, the initial reaction is going to be a dovish repricing, even a modest one you would expect. As you said, it may lead some to think the Fed may push on the pause button or at least hover over it. But I think when you then start to dig into the data and you start to look at it the way the Fed are looking at things, you may then see that initial move unwind. And I think I'd be paying very, very close attention to any Fed speakers that we get on the wires later on this week after that inflation data to see how they're gauging it, see how they're responding to it. And that could be the catalyst for any dovish repricing to unwind. I think for me, 25 bips at the end of the month is nailed on, whatever happens. It's now a question of, similar to the ECB, what happens in September? And that's a question we answer after the summer, in my mind. Well, I'm sure you've imparted some pearls of wisdom there, but I can't hear you.
Sorry, someone on my mic there. I was going to say, is that your three answers in that one, or have you got two more to go?
Well, there could have been about 100 answers in there. I'm not too sure.
Yeah. So, I mean, this one thing I will say about this report is that on Thursday, the day after, we get the PPI numbers, and that could, in fact, be more important than the CPI numbers. If CPI comes down to where it's expected, the market, it's going to be pretty happy with that. But the PPI number, if we start getting negative year-on-year numbers, that's proper disinflation, or I won't call it deflation, disinflation pressures coming in. We've seen that coming into a lot of European PPI numbers now, negative year-on-year numbers. There is a lag between them. So even if you get a hot CPI number, maybe it doesn't fall as much as expected, or even goes up in the year-on-year measures. If PPI is negative, again, the market's going to look at those numbers and think, right, well, this is going to come into CPI at some point with the lag. So we may ignore this high CPI print this week that we saw yesterday, because the PPI numbers are saying something different as well. So it's another episode in the story of what happens with central banks and the market.
Absolutely. And don't we love it? And we love it so much that we're now going to do 2 whole rounds of Topical Thunder on more monetary policy shenanigans. We'll start with Dick Matthews' favourite subject, friend of the show. I'm actually having lunch with him this week, the Bank of England here in the UK. Rate expectations seem to be going rather berserk once more. The market now pretty much fully prices in a 50 bip hike from the BOE in August. I think something like 46, 47 basis points worth of tightening is priced. So we can pretty much say that's a fully priced in move at the August meeting. Terminal, when I checked before we filmed, is now priced at around 6.5% in terms of the peak bank rate. At one point last week, I think the market saw an even chance of getting to 6.75%. It all seems to be getting a little bit out of hand. And I think the most interesting thing was that there wasn't really anything in terms of big catalyst to spark that move last week. I think it was more a function of the sell-off that we saw in the treasury market and also in gilts really starting to filter through. But in terms of economic data, it was a pretty light week here in the UK. It's a little bit busier this week. I mean, by the time that you watch this recording, the May labour market report will be out. And the jobs data is really important, because if you think back to the April jobs report that we had at the start of June. Why the UK does this on a 2-month delay is beyond me, by the way. But that was the first release that really started to shock markets and also shock policymakers into a much more hawkish reaction from the BOE. It was that, coupled with the big upside surprise on inflation a week afterwards, that pushed the BOE into that surprise 50 basis point move last month. And I think that's why we need to pay really close attention to the jobs data that we're going to get from the UK this week. It's the earnings component that we're all focused on. In the month of April, regular pay rose by 7.2% on a yearly basis. That's a record pace outside of the pandemic. If we get anywhere near that or even above that this time around, then that is certain. Well, one, I'd like to know who is getting that, please. And secondly, it is going to cause another significant hawkish repricing of the UK rates curve, you would expect. We also have the GDP figure for May a little bit later on this week. That is pretty much guaranteed to see a contraction given the extra bank holiday that we had. And we've also got a few BOE speeches. I think Catherine Mann is speaking later on this week. Andrew Bailey is giving his address at the Mansion House dinner, tonight on Monday night. So again, you'll have seen that by the time this recording comes out. But I'm going to get on to sterling a bit later on in my play of the day. But I want to get your thoughts on this, Ryan, because if you look at the market at the moment, you've got very, very aggressive and perhaps even over the top pricing in terms of BOE policy. You've got long positioning in sterling, which is looking very, very stretched at this point. How much further can the pound really go? We got to 28.5 and seemed to stall out last week. Do you think we're at a point where momentum may now start to reverse?
Yeah, well, a couple of points there. Firstly, it shouldn't be a surprise to anyone who watches this show that we've been saying about wages in the UK being hot, about all the strikes and how those wage pressures are still yet to feed through and are feeding through now. So I don't know why the market couldn't see that wages were going to remain hot. They could remain hot again this month because there's still been more pay disputes and resolutions and hot numbers coming through from there. So I'm not expecting that side of things to cool down significantly. But as far as expectations for the Bank of England go, we've been saying it for a few weeks now. I think they are getting very extreme. I think it was JP Morgan who in one scenario saw 7% rates last week coming.
Yes, you're right.
It's getting bonkers. And they're still changing expectations. I think it was Goldie's yesterday over the weekend went up to 6.75 on their peak rate now. It's getting very, very silly up there. And this is coming from someone who thought that the BOE would be taking rates that high. So I'm waiting. I'm sitting here on my hands trying to keep my powder dry. I'm not sure if that cable move yesterday was a decent trade to get in. I'm not going to steal your thunder on that one. I am looking to start shorting the pound. I've got a big itch that I need to scratch about shorting the pound, because if the Bank of England do continue to follow with hikes, I don't say they're getting up to 6%, 6.5%, anywhere like that, but getting up 5.5%, 5.75% is going to put some pressure on the UK economy, and it's going to come pretty hard. And in that scenario, I don't want to be long the pounds, and I want to start getting into shorts. But on your point quickly on the GDP, I'm going to take the other side of that trade, because there were bank holidays, but it was also the coronation and stuff going on there. So I think people are going to add a little bit of a splurge, as we saw with retail sales. I think that's going to give GDP a little lift, and hopefully I'll follow up with the ISM. I just missed with my prediction last week by 2 pips.
You did, yeah.
I'm going to see if I can keep it up on the data calling front.
Well, go on, give us a number then.
Oh, giving up. Up 0.2%. Rocket.
Up 0.2. There we go. We got a number out of him in the end. And I think just very lastly on the BOE behind you there on the left is the problem they've now got is they don't have enough credibility to, and I was discussing this on a call earlier, they don't have enough credibility to push back on what the market is pricing in and on what the sell side is saying. It's not a case where they can come out and say, we expect inflation to be, in a nice disinflationary trend by the end of the year, on its way back to 2%. We're not, the market has priced in too much in terms of policy tightening. They don't have that luxury because they don't have the credibility to do it. Because if they were to come out and say that, the market, you and I would sit here and go, well, this is absolutely ludicrous. Look at their forecasts over the last 2.5 years. There's absolutely no way this is going to be right. Even if they did turn out to be right, the market will punish them if they tried to go down that path. So, yeah, Mr. Bailey is stuck firmly between a rock and a very hard place at this point, isn't he?
Yeah, well, 2 meetings ago, he hoped he didn't have to hike again, and then he went with a 50-pip hike. So, you don't need to say much about what they get right and get wrong over there. But I still think the clock is going to be on their side, and probably from August, they may start seeing inflation actually move in the way they want it to.
Yes, exactly. But he's only paid half a bar a year, so we can't feel too sorry for him.
Yeah.
Anyway, what about the Bank of Canada? What are we expecting there this week?
Yeah, well, another central bank this week, and another one where it's a question of a bit of a coin flip as to whether they hike or whether they pause. They came off their pause last meeting due to higher inflation and a still strong labour market. They also mentioned that the housing market was picking up over there. Since then, we've had another inflation report, and it fell back a whole 100 pips to 3.4% from 4.4%. That's much closer to their summer forecast of easing to around 3%, as they put in their statement. But last Friday, as well as NFP, we saw Canadian jobs coming in much stronger. The unemployment or the employment change was up 60,000 versus 20k expected. That followed a minus 17k in May. The revolving door between full-time and part-time went in favour of full-time workers, a massive 109,000 added on there versus a loss of 32k in the last month. Part-time, that lost 50k, that was up 15k in the prior report. So a big shift there, as can often happen between the full-times and part-times. Unemployment rate, that actually rose more than the 5.3 expected to 5.4% from 5.2. But that was likely due to the participation rate rising 2 pips as well to 65.7%. It's why we always talk when looking at the jobs numbers and unemployment rate, what has happened in that participation rate, because it can add and take away from that unemployment rate. So for the Bank of Canada and their pause or not to pause, on the inflation front, there's plenty of evidence to say that they can pause because they're getting down towards their summer target. But on the jobs and the rest, we might get another hike. So for you, Michael, heads or tails?
Oh, blimey, that's the second time you've put me on the spot today, isn't it? I'm not sure I like this.
I'll make it easier for you. Heads I win, tails you lose. Which one?
Well, no, the way this show normally goes is heads I lose, tails I lose. So I think they hike again. I think it's just the path of kind of least regret, to steal an expression from Westy. The market price is in about a 70% chance that they do raise rates, which I think is reflective of that cooler than expected inflation number that you mentioned. And actually, when you dig into the inflation figures in Canada, what was it, 3.4% on CPI? I think about 2.5% to 3% of that is actually a result of rising mortgage costs. So it's effectively the BoC generating their own inflation with that. When you take it out, obviously they're pretty much at target. But I do think that they're just going to be very, very cognizant of the fact that with the market pricing in further tightening, if they weren't to deliver it, it would be, well, firstly, quite a significant loosening in financial conditions, which I think they'd want to avoid. And secondly, it could put markets, lead to the market starting to think, actually, if we're now on pause, when are we going to cut? We're at terminal, and start to price in some policy loosening, which I think they will probably want to avoid doing. But I think it is very much going to be a case of quite a cautious hike, moving rates to 5%. And then, we are now going to wait and see what happens for the remainder of the year. The other one that's happening this week, and we haven't mentioned it here, and just very quickly to touch on it, is the Reserve Bank of New Zealand. And I think that's a lot easier to call. I think they are on hold. They're done 5.5%, and they're staying there for the foreseeable, I would imagine.
Okay, we'll timestamp that one for you when they hike 75 pips tomorrow morning.
Are you going to be up at 3 a.m. Wednesday morning to watch that one?
No chance. Absolutely no chance. Pick it up after. I really am split. It's going to make a mockery of the whole thing if they do pause, because then they are following the RBA. I'm talking about the Bank of Canada, sorry. Who hiked, paused. You can't be doing that with central bank policy. You don't get enough time to see the effects of your hikes coming through to be able to switch on and off like that, meeting to meeting. So I think a 67% chance or 70% chance of a hike is probably about right. But it wouldn't shock me if they paused just purely on those inflation numbers getting back near their target.
Good stuff. Right, let's get into some charts. Right, I'll keep this one relatively short and sweet, because I've talked about the S&P 500 about 1 million times since we started filming the trade-off. A bit of a different chart this week, because I felt like I was going to be murdered if I used the previous chart again. Ryan was...
I'm still going to murder you. This is just dressed up in some other clothing. Go on.
It is. It absolutely is. It's a wolf in sheep's clothing, or whatever they call it. What I'm showing here is in white is the S&P 500. This is a year-to-date return for those interested, up about 15%. Very, very strong, as we all know. The blue line is the equal weighted version of the S&P 500. So the S&P is a market cap weighted index. If you weight every stock equally, you get the blue line, and you can see it's up only about 5% year to date. What I want to look at, though, on this chart is the fact that, for much of the year, we've seen this big outperformance of a small number of stocks. The really mega cap tech names is what's been pushing the market higher. And that's why we've had this big divergence that started in kind of March, April time. We're starting to see signs that this divergence may be closing a little bit. Some of the sectors that have been lagging are now starting to pick up a little bit of a bid, starting to see a little bit of a rotation. And if we see that continue, it's obviously going to be a positive for the broader index, which you would expect to continue moving higher. It's just another bullish catalyst to add to my ever-growing list with a lot of cash still on the sidelines and volatility remaining pretty low. Obviously, we had those losses last week. I think any weakness for me is still a buying opportunity while we remain north of 4,400. But also just keep an eye on earnings season. I know we kick off with the banks on Friday. They're not. The earnings from the banks are going to be used more as a kind of bellwether, as a gauge of where we may go over the remainder of earnings season. So I think that's important for sort of near-term sentiment, but it's going to be a couple of weeks until we get those big tech earnings from the likes of Meta and Microsoft and all the rest of it. And they are the ones that could really have an outsized impact on the market. But just a different way of viewing things, and maybe some signs of a catch-up beginning to come through.
Yes, I've got a question for you. Should we be worried about the banks? Because obviously they were nice and healthy in the Q1 numbers, but now they've come through this banking crisis, the SVB stuff, and a lot of banks picking up some of the regionals, paying up a lot of money for them and having to cover deposits. Is that going to affect performance of the earnings, do you think? And would that be a bit of a false flag, if you like, in terms of health of the banking sector?
That's a good question. I think it could. This actually might be one for us to dig into a bit more next week, to be honest, because I think we could do about 10 minutes on it. In short, regional banks going bankrupt or going pop is going to be good news for those on Wall Street in terms of deposit bases. The key thing to watch is what are they putting away in terms of shoring up their liabilities and their balance sheet. What you or I would call a kind of rainy day fund in our personal lives. What provisions are the banks putting away for that? And does that depress earnings at all? And obviously we will find out more on Friday afternoon when JP, Citi and Wells Fargo begin to give us their numbers.
Yeah, and maybe then you can find another chart, a different chart to show the S&P in, and we can have another way of looking at it.
It's my life's work at this point. Right, let's move on.
Yeah, I'm going to go back to the UK and looking at 10-year yields, and we've just been speaking about the market getting too extreme, and there's a great thing about when market sentiment these days, and its ability to take a bias or a side to the extreme. Because when that happens, it can give us some huge trading opportunities when those extreme thoughts don't materialise and the market has to undo what it's traded. That's something that we've just spoke about is evident in the UK rate expectations. We've had calls for 7%, market moving up their rate hikes and for the Bank of England, and it is getting to a bonkers situation for me. UK yields are moving up as part of the general move in rising yields in their peers. But we have to remember that yields rising mean bonds are being sold, which means money has to be coming out of there and going elsewhere. Now, one could point a finger at QT for being a big reason why yields are rising. Who wants to buy bonds when every central banker who's got QE is offloading it under QT and getting clear of their balance sheets? However, there will come a time when bonds will be back in fashion. And if the expected high rate induced economic slowdown happens and rates have to come down to compensate, I think for the UK, the higher interest rates go up, the harder the bump for the economy will be down the line. And that's when UK yields will suffer more than their peers. So I think if we get US 10-year yields up into that zone you can see on the chart, and we're talking up into the sort of 5.5% to 6% area, that would be my indicator that the market is actually hit extreme point and to maybe start countering that move. So remember, it's not about all the bank calls saying 6.75. It's what the market does. And if we get up into that high 6 area in something like yields, that's maybe the time I'll be looking for a turn.
Yeah, I mean, I think I'd be looking for a turn before then, to be honest. I mean, 4.6, 4.7% on a 10-year gilt. It's ludicrous. It's absolutely ludicrous. It does feel like you're kind of trying to almost catch a falling knife here in terms of if you were looking to buy bonds and go long duration. But I think the time is coming, and I don't think that time is too far away when the market sits up and realizes that, long rates being at these levels is probably 100, 150 basis points higher than they actually warrant being. And I wouldn't be surprised to see us retrace quite a lot of the ground that we've made up. And there's 2 points I would make on that. One is you said who's buying bonds. There is one group of people who are going to be buying an awful lot of bonds, particularly gilts, and that is private individuals who want to buy gilts as a tax-efficient savings vehicle. That's not investment advice. That is just a fact. It is tax-free gilt capital gains. And you are going to see a lot of people do that, I would expect. And the second thing I would mention is if we do see the long end of the curve on a yield basis come lower, then that is going to alleviate at some point quite a significant amount of the pain that you're seeing come through in the mortgage market. I think the average 5-year fix is now north of 6%. The 2-year certainly is. And if we do see yields turn, then that is obviously going to be a spot of good news, a very rare spot of good news for mortgage borrowers as well.
Yeah, definitely. But I think we're not going to see that until perhaps the economy starts turning. That will really spark things off, which will be good for rates, as you say. But I think there's going to be a lot of pain ahead still for mortgage holders for now.
Oh, absolutely. I think if anyone, the next 6 months are going to be pretty brutal in the housing market, I would imagine.
Yeah, and we'll wait to see what happens with house prices after that. Are you in the market for anything to add to your portfolio?
I do not have a portfolio. Let me just clarify that for our viewers. But I do think there are, let's put it this way, there are going to be some bargains to be had, I would expect.
Good time to start a portfolio then in about 6 months' time.
There you go. I'll invite you to the estate at some point. Right. Let's have a look at the euro. By and large, FX volatility is still pretty quiet. I mean, the moves we saw after the jobs number were nice, but they weren't exactly huge. I mean, 0.5% or so in most G10s, if not a little bit more. Payrolls ain't what it used to be, is it? Let's put it that way. Looking at euro dollar, though, I mean, this is all a dollar move or a dollar led move at the very least. There's been very little in the way of euro specific catalysts to cause any sort of a move here over the last week or 10 days. In fact, if you're looking at specific Eurozone catalysts, you really start to look at China, and the news there remains rather disappointing. So it is all a dollar driven move. And actually, I think a lot of it is technically driven as well. You see on the chart there how well the price has respected as support both the 50 and the 100-day moving averages in pink and green, respectively. We're getting up towards this 110 handle now, which obviously is a key psychological level. It's also a key technical level going back absolutely donkey's years when you look at euro dollar. So the question now is, are we going to get a nice push through that level, or are we going to see the rally run out of steam once more? Personally, I think it's a bit of a high bar for us to see any sort of sustained breakout, particularly given the time of year and the lack of any kind of catalysts on the horizon. So if you are looking to fade a bit of a short-term move, then selling into some of this strength with a stop just above 110 could be something worth considering. But I think it just epitomizes the kind of range-bound, quiet, subdued nature of things at the moment.
Yeah, and at times, that's all we need as traders. This one has been going sideways quite a lot. I was thinking maybe we get a little test of the 108 level last week, but we only got down to 108.30s, that area. Top side, like you mentioned, we had that move to 111. That held really strongly. Now we've seen 110 as resistance. I'm a bit cautious on a 110 short, depending on how we get there. We're sort of not far off it. And when we hold below somewhere for an extended period of time, that tends to build up some pressure. So I would keep it tight if you're shorting against 110, just in case we get a bit of a blow through. But if that happens, 111 is going to be on my radar, definitely. And as I said, down to the downside, into 108, a big level down there. If we see that range confirming over the summer, that's 250, 300 pips you got to play with for a nice bit of summer trading, and make life easy.
Exactly. Play the range. Don't do anything stupid. Leave a tight stop in there, and put your feet up while the market's not moving too much. What more could you want? Well, one thing you might want is carry.
Yeah, you might want carry.
It's almost like we rehearse this, isn't it?
It's like we do. But and this is my next topic. Is this the end of the carry trade? There's been some growing talk that perhaps the carry trade might be reaching its limits. Certainly, $MEX rising last week added to that talk, but we've moved back down since hitting sort of the 1740 area, which was a big support area on the way down. And I don't think there's going to be too many long-term carriers, let's call them that, getting worried because they're locked in at much higher levels. But what could be interesting is if we further develop support around these low 17s. If we survive another test down there, that's likely to drive out more short-termers who will be thinking they better take more chips off the table in case of another bounce. So a second bounce may spell trouble for the 1740 area, probably driven by a lot of those short-term players getting out. And we could see a bigger bounce up to the 1760s. It's always worth noting that when you get such one-sided moves such as this, they can be pretty volatile when they do go the other way, because everyone is in the same trade, and as soon as one person starts running for the exit door, you tend to drag a few more with them. The carry trade overall is something that's obviously a big part of a lot of investors, to do with central bank divergence, particularly if you look at dollar yen with, the Fed up in the 5% and the Bank of Japan in the negative whatevers, as they still have been. So there's always, particularly Japanese investors like playing the carry trade as well in FX. So nothing ever goes one way forever, but I'm looking at that 17 level. If we get another hold there, I might be tempted to dip in and see what happens on the long side.
Yeah, it's an interesting one. I'll keep this short and sweet because I have absolutely no edge whatsoever in EMFX. I mean, some would say I don't have an edge in G10FX, but that's a conversation for another day. What I do think is interesting, though, is you saw $MEX bounce a little bit, as you've said. You also saw the yen rally quite significantly last week, even though the 10-year Treasury was, 22, 23 basis points higher on a yield basis on the week, which is a bit of a breakdown. Again, coming back to that point you touched on earlier, a breakdown of the usual correlation that you would see. So the carry trade has certainly been something that a lot of traders have been partaking in over the first half of the year. Obviously, one swallow doesn't make a summer, 1 week doesn't make the end of a certain trade, but it's definitely a theme to pay close attention to, because, and I think we're probably a way off this at the moment, but as we both know, when these trades unwind, they can do so quickly and quite violently.
Yeah, exactly. And they have to start somewhere. They always start somewhere. So getting little clues like that, and you can see that 17 area, low 17s is a big form of support and resistance area. And if that's where it's going to stop, that's where it's going to stop. And the price action will tell us that.
Exactly that. Right, let's get into our plays of the day. Right, cable for me. I'll keep this quite short and sweet because we've spoken about the pound at some length today. I've zoomed into a bit of a longer run chart here just so that you can see we've again kind of stalled out at this 128.5 level. That was where we got to the highs that we saw towards the tail end of May, start of June. Backed off a little bit. We're having another go at it. We couldn't quite get above it towards the tail end of last week. And in early trade this Monday, as the week gets underway, we're backing away from it once more. I've given plenty of reasons during the show to be bearish sterling. I think the bar for the BOE to deliver on what the market is pricing in is very, very high. It looks like we've gone a little bit too far, too fast in terms of gilts, in terms of OIS pricing. So I do think we are going to see a bit of a disappointment there compared to in terms of what policymakers deliver compared to what's priced in. That, coupled with the mortgage cliff that we've got coming up, the growth slowdown that we're likely to see later on in the year. I would be looking to fade the move here in cable. I know Ryan is sitting on his hands. I am happy to get into this at the moment. I'd be looking over the medium term for us to get back down and initially towards the 50-day moving average, which currently is at 125.80, perhaps even lower than that. And hopefully, me being short cable works out better this time than it did the last time, when I think we were trading about 125 and we're now trading 128. So keeping my fingers crossed there. Ryan, I believe this one is a viewer request, if I'm not mistaken.
Yeah, last week we asked the viewers to step up and give us what they'd like to see on our plays of the day. And so this one is one of our viewers, Arnis, who wanted to look at EURCAD. And it's an interesting pair because it does really like to play nicely with the levels. Obviously, we've got the BoC this week, which might give us some more interesting levels to trade. On the top side, the main one is up at 146.50. As you can see there, got a big, thick red line there. It's really been a doozy of a level up there. And the sort of level we love as traders, that you know it's going to have a chance of holding. So I'm going to keep my eye on that for a possible short if we get a drive up there based on the Bank of Canada. For the buy side, I have been waiting for a move to the 38.2 and the prior bottom or double bottom around 142.30s. It's probably going to be out of reach for the BoC unless there's a big shock. But it's worth keeping a note of anyway. Otherwise, into the big figures, 144, 143 would be my choice for longs. What I would warn is we have a press conference with this BoC meeting, and it's important to watch out for second wind moves. So whether you're trading this one, the Loonie, any other CAD pair, you tend to always get a reaction on the announcement. Then the market likes to suck you in and thinking, oh, yep, you're all done. Then it goes a bit quiet. You have the press conference. Straight after, well, up it goes again. So watch out for that second wind move in CAD pairs, particularly this one after the press conference, if there's any big news. But for me, yeah, nice sell up at the big resistance and buying the dips into the big figures.
Indeed, and sage advice as always in terms of waiting for the pressure as well. We've seen that not just with the BoC, but with the Fed on numerous occasions. The market goes one way on the decision, and then Powell steps up, and we go completely the other direction. Right, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer Kyriakos for bringing this together as well as he always does. I'm going to get him some reflexes training. He's a little bit slow on some of the transitions, but we can speed him up in time for next week. We'll get some coffee inside him. If you've enjoyed,
you go at that, mate. I'd love to see you in his shoes. Actually, we've probably. I dread to think what we'll have on the screens.
we can do a role reversal next week. God knows what sort of trade-off you're going to watch, but I'm happy to give it a go. We will be back.
Don't get to talk about the S&P again. I'll be happy with that.
We will be back next week in some form and with some form of S&P 500 chart, I'm sure. If you've enjoyed the show, drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, your thoughts on the show. And if you've got any trade ideas that you want to share or we want to discuss, then by all means, let us know. But for now, it's goodbye from us, and we'll be back again this time next week. Thanks as always for watching.